Warren Buffett, the Oracle of Omaha, a name synonymous with investment acumen and unparalleled financial success. He consistently ranks as one of the world's richest people, a testament to his brilliant investment strategies and keen understanding of the market. Yet despite his immense wealth, he's widely known and admired for his simple, remarkably frugal lifestyle. He still resides in the same modest Omaha house he purchased back in 1958, a tangible symbol of his grounded nature. It's a home, not a mansion. Instead of indulging in extravagant luxury, his days are primarily filled with reading and deep thinking, activities he considers essential to his success. These habits reflect his disciplined and methodical approach to both life and investing, a cornerstone of his enduring success. Buffett's core philosophy is remarkably clear and consistent. True success isn't about ostentatiously flaunting wealth or material possessions, but about accumulating it intelligently, strategically, and patiently over the long term. His investment style is refreshingly straightforward and accessible, a departure from the complexities often associated with high finance. He focuses intently on understanding a business's true intrinsic value, its fundamental worth beyond market hype. He achieves this by largely ignoring the short-term noise and fleeting trends of Wall Street. He analyzes companies deeply and meticulously, carefully evaluating the quality of management, its competitive position within the industry, and its long-term growth prospects. This time-tested method has consistently helped him outperform the market and generate exceptional returns for decades. Buffett's annual letters to Berkshire Hathaway shareholders are legendary for their clarity and wisdom, distilling complex financial ideas and strategies into simple, easily understandable, and timeless principles. He proves that you don't necessarily need an advanced PhD or a sophisticated supercomputer to achieve significant financial success. All you need is patience, a high degree of emotional control, and an insatiable hunger for continuous learning and knowledge acquisition. Indeed, most of his day is dedicated to reading extensively, diligently absorbing vast amounts of information to make rational, well-informed, and fact-based investment decisions. For any aspiring investor seeking to emulate his success, adopting this disciplined mindset and commitment to lifelong learning is undoubtedly the crucial first step toward achieving long-term financial success and security. Even as a young boy, Buffett's business instincts emerged remarkably early, showcasing a natural aptitude for commerce and investment. It was clear from a young age that he possessed a unique understanding of how money worked. One of his earliest ventures involved buying 6 packs of Coca-Cola for 25 cents. He then sold each bottle individually for a nickel, a simple yet effective lesson in the basics of profit and understanding brand value. This early experience instilled in him the importance of margins and recognizing a valuable product. He optimized his paper route, not just delivering newspapers, but maximizing efficiency and cleverly upselling magazines and calendars to his customers along his route. Spotting opportunity even in discarded items, he and a friend pooled their resources and bought a used pinball machine, recognizing its potential for generating income. They strategically placed it in a local barbershop and soon expanded their operation to several locations, giving him his first real taste of passive income and the power of scaling a business model. These early ventures weren't just about making money, they taught him valuable lessons about profit margins, the importance of reinvesting earnings back into the business, and the undeniable power of establishing a competitive edge in the marketplace. By his teens, Buffett had already saved thousands of dollars, an impressive sum of money, especially considering the economic landscape of the 1940s. Through these experiences, he learned firsthand about the value of assets, the significance of consistent cash flow, and the importance of nurturing strong customer relationships. These early, hands-on lessons provided him with a practical and intuitive grasp of fundamental business principles that most people only learn in business school. This solid foundation would later profoundly shape his unique approach to analyzing companies and making investment decisions on a much larger, global scale. Even at a young age, Warren Buffett displayed an entrepreneurial spirit. At 11 years old, he wasn't just thinking about the future, he was actively building it. He took a significant step into the world of finance, making his first stock purchase, 3 shares of Citi Service Preferred. This wasn't just a financial transaction, it was a pivotal moment in his journey. However, the market can be unpredictable, especially for a young investor. The stock quickly dropped, presenting Buffett with his first real test of financial resilience. This initial downturn tested his nerves and provided an invaluable early lesson about market volatility. It was a trial by fire, teaching him that the market doesn't always move in a straight line. Showing a glimpse of recovery, the price rebounded slightly, offering Buffett a chance to recoup some of his investment. Eager to secure a profit, he sold his shares for a small gain, a decision he would soon come to reconsider. To his dismay, he watched the stock soar much higher afterward, a painful lesson in patience and long-term investing. This experience, though initially disappointing, taught him 3 vital lessons that would shape his investment strategy for decades to come. First, don't obsess over daily price swings. Focus on the long-term value of your investments. Second, avoid making decisions out of fear or greed. Base your choices on sound analysis and rational thinking. And most importantly, be patient. Time is your greatest ally in the stock market. Had he held on to those shares, his initial investment would have multiplied many times over, showcasing the power of compounding. The real secret to wealth in the stock market, he realized through this experience, is long-term thinking and letting value compound over time, a cornerstone of value investing. This early mistake, though a learning experience, profoundly shaped his investment philosophy, teaching him that successful investing is often about disciplined inactivity, not constant action or knee-jerk reactions. The biggest profits, he learned, go to those who buy right and sit tight, allowing their investments to grow steadily over the years. Buffett's first foray into stocks wasn't just a transaction. It was a profound lesson in the power of patience and the importance of a long-term perspective. It set the tone for his entire investing career, guiding his decisions and shaping his approach to the market. For Buffett, the market rewards conviction, a long-term vision and time, not frantic trading or short-sighted speculation. Buffett's education at Columbia Business School introduced him to Benjamin Graham, the father of value investing. Graham's core idea, a stock is ownership in a real business, not just a ticker symbol. He taught investors to ignore the market's emotional swings, personified as Mr. Market, and focus on intrinsic value. The key principle was margin of safety. Buy at a significant discount to what a business is truly worth. This buffer protects against mistakes and uncertainty. Buffett absorbed these lessons, learning to analyze financial statements and calculate true business value. Graham's cigar butt approach, finding companies trading below their net assets, was a starting point. While Buffett would later refine this strategy, the foundation was set: buy businesses, not stocks, and always demand a margin of safety. These principles became the bedrock of Berkshire Hathaway's success. Value investing, as taught by Graham, shaped Buffett's entire approach. Influenced by Philip Fisher, Buffett evolved beyond Graham's cigar butt strategy. His mantra, "It's better to buy a wonderful company at a fair price than a fair company at a wonderful price." He looks for businesses with durable competitive advantages, what he calls economic moats, like strong brands or cost advantages. Buffett invests only within his circle of competence, sticking to industries he truly understands. He avoids speculation in unfamiliar sectors, focusing on simplicity and clarity. Management quality is crucial. He seeks leaders with integrity and skill. When these criteria are met, he waits patiently for a fair price, still demanding a margin of safety. He's willing to pay more for quality, knowing great businesses compound value over decades. This disciplined approach is the core of his investment success. Buffett's defining trait is patience. His favorite holding period is forever. He buys with the intention of owning a business for decades, letting compounding work its magic. Unlike traders chasing short-term gains, he ignores market noise and focuses on long-term fundamentals. He only sells if the business deteriorates, management loses trust, or a better opportunity arises. This discipline means holding through market crashes and resisting the urge to sell during booms. He knows business value and market price can diverge in the short run, but will align over time. His buy and hold strategy is also tax efficient, deferring capital gains and maximizing compounding. For most investors, frequent trading erodes returns through costs and taxes. Buffett's lesson patience isn't just a virtue, it's a powerful financial tool. Letting investments grow over time is the surest path to wealth. The real engine behind Berkshire Hathaway's growth is insurance float. When Buffett bought National Indemnity in 1967, he gained access to float, the premiums collected but not yet paid out in claims. This float acts as an interest-free loan, giving him massive capital to invest. By running insurance operations at break-even or better, Buffett essentially gets paid to use this money. Over time, Berkshire's float grew to over $100 billion, fueling ever larger investments. Profits from these investments are reinvested, creating a self-reinforcing cycle of growth. Well-managed insurance means Buffett is paid to hold float, a rare feat in the industry. This financial structure supercharged Berkshire's expansion and scaled his value investing philosophy. Float is the secret weapon that made Buffett's empire possible. Buffett's journey offers a timeless blueprint for investors. First, think like a business owner. Understand what you're buying and focus on long-term value, not short-term price moves. Emotional discipline is key. Stay rational when others panic or get greedy. As Buffett says, be fearful when others are greedy and greedy when others are fearful. Commit to lifelong learning, but invest only within your circle of competence. Don't chase trends you don't understand. Stick to what you know and expand your knowledge over time. Embrace simplicity and the power of compounding. Start early, invest consistently, and let time do the heavy lifting. Wealth isn't built overnight, it's the result of sound judgment, patience, and discipline. Buffett's story proves that small, steady gains can grow into a fortune. The real secret: stick to proven principles, and let compounding work for you.